Hello and welcome to another Daily Dose of Insights powered by Container Exchange. My name is Christian, and every other day we bring to you the key news, stories, and data points that move container markets and hence your business. Today is Friday, so we have our Fundamentals Friday here at Container Exchange, where we typically look at one key question that's sort of top of mind and that warrants a deeper look and a deeper discussion. We want to also provide a little bit of a food for thought for the weekend, for your weekend, so to speak. So let me quickly share my screen to give you a little bit more guidance of what I'm talking about. For me right now, the biggest question in the market is how will, of course, freight rates and container prices develop in the next 3 to 6 months. We've seen since about the end of 2023, we've seen a significant uptick both in freight rates as well as in container prices, with a bit of a dip in between, but that has since been recovered by strong underlying demand for ocean shipping capacity, especially on Trans-Pacific. Now, the question is, will that hold up over the next 3 to 6 months? And for me, let's split this into the arguments for whether they go up or at least stay sideways, so at very, very elevated levels, or whether they will go down and potentially down significantly. Arguments for going up or at least staying sideways. Well, disruptions in the Red Sea will persist and continue to soak up capacity. There's realistically no political or military solution to this situation. And also it remains questionable whether the Houthis will stop their attacks once the situation in Israel or at the Gaza Strip is being solved. Essentially because the Houthis also pursue their own regional interests supported by Iran. Then labor disputes, for example, the Canadian Railroad, US East Coast terminals, etc., will lead to further slowdown of container turnaround times. What this means is that essentially a container takes longer from point of loading to empty return again, and that if you have a slowdown in that, you need more containers for the same amount of freight because you can use the container fewer times during a year. Rolf Jansen made some very interesting comments on this also in the last, press conference of Hapag-Lloyd. And we will see a soft landing in the US, leading to continued healthy demand for containerized imports. So the demand side will remain healthy. The economy will remain resilient. And then, of course, the question is whether carriers will maintain pricing discipline. And if that's the case, then we'll continue to see healthy and strong rates. On the flip side, what are the arguments for rates and container prices going down and potentially significantly? Well, for once, capacity injections, so vessels and containers, will lead to oversupply despite continuous disruptions and slower turnaround time. So we do still see vessels, new builds coming online at an almost unprecedented pace. And at the same time, also 2024 is poised to be the second strongest container production year on record, with, of course, the strongest year being during the pandemic. Then it's questionable whether we will really see a soft landing in the US. So there's significant pressure now on the Fed, on Jerome Powell in the US to cut interest rates because there's dark clouds on the horizon, namely on the US labor market that might show that also the Fed has reacted too slowly in cutting interest rates and might now be forced to reduce rates at a very, very fast pace. So there's a question whether this reaction might have been too slow and whether this will endanger potentially the soft landing in the US. But even if we do see that, it is a question mark whether we will continue to see the current ocean freight demand growth because there is continued supply growth, as we just highlighted. So to counter that, you really need continued strong ocean freight demand, just like we've seen over the past couple of months. And then lastly, the question was whether will carriers maintain pricing discipline? My argument or our argument against that is that new entrants on e.g. Trans-Pacific, so for example, TS Lines, Sea Shipping, Hede International Shipping, they're already putting pressure on the main lines by undercutting their rates and trying to steal market share. So the main lines will be forced to keep up and to reduce rates, and that will lead to some form of a price war of course, aggressiveness TBD, but some form of a price war on Trans-Pacific. And we do believe that this will, how do you say that, diffuse to other trade lanes as well, just like we always see. Now, how the market will react over the next coming weeks and months, of course, you have to decide for yourself. You'll have to think about that for yourself. Our view is that I don't think that prices will remain as elevated as they are today. There's too many question marks there, too many potential downsides, and at a very high rate level that we are already at, of course, the downside risks sort of outweigh the upside risks. And that's why we're a little bit more pessimistic there. Now, that's it from me, from us for today. Thanks a lot for tuning in. Have a fantastic weekend and see you all on Monday. Take care.